How's it going out there? It's December 7th. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down the headlines and tell you what's really moving these markets. So I like to have fun with these podcasts and make them entertaining as hell while educating you on the way and giving you lots of ideas to make money on. But today's podcast is going to be a little serious. You should pay attention. Because we are heading into 2022 where we will see a very difficult and volatile market. Really, really tough conditions. And we can look at the past few trading days alone, which have been nuts. Dow's down 400 points as Omicron surfaced. People worried, they should be at the beginning, right? Holy cow, it's spreading to different countries. And, you know, the markets got hit a little bit, worried about more lockdowns and less international growth and stuff like that. I get it. Then we rebound a little bit the next trading day. And what do we have? We have Powell go on TV and do a complete 180. Says we're going to need to raise rates as inflation's no longer transitory. It's going to happen sooner, probably next year, mid-next year. That was a big surprise. Not the inflation part. Everybody knew there's inflation except for the Fed. The smartest guys in the room don't know because I don't know if they get their stuff served to them. They don't have to pay for that shit. I have no idea how the smartest guys in the world that make a fortune can do very, very well, and they're in Fed and control money supply. These people had no idea that inflation was not going to be transitory, right? We all knew that, right? My daughter knew that. They just didn't know that. But what was a surprise in the market is, yeah, we saw inflation rise, but we just didn't. We all thought, hey, they're going to say it's transitory for another year or two, and then, you know, maybe then start raising rates. But he said, nope, it's no longer transitory. It's here. And he used Omicron as an excuse, which is fine. But that spooked the markets, and the markets fell sharply. Yesterday, Dow surges 600 points. Nice rebound. Another 400 points as of right now as I'm looking. 460 points to be exact on the Dow. This is mostly if those fears about Omicron within 5-6 days are easing, since it doesn't seem to be a dangerous variant as of now. So everything's fine. We're okay. Again, that's just the past 8 trading days. Now, if we look back over the past 10 years, what have we had? Why have we had one of the biggest bull markets in a generation? We had an economy which is known as Goldilocks. It's not too hot, not too cold. But we had strong earnings, but jobs are kind of weak. Average of slow GDP growth. When you look from 2010, 2019, GDP was only above 3% twice, and now is barely above 3%, 3.08% in 2015, and 3% exactly in 2018. But kind of slow. It wasn't like, 4, 5, 6%. Holy cow, it's heating up. The market's heating up. Inflation could, no. It was just like hot and cold. Not too hot, not too cold. We had tariff issues with China, potential government shutdowns, which happen every freaking month, so politicians are assholes. We all know that. Earnings were pretty solid. But then you had interest rates, especially 10-year, remained relatively low historically and kept pushing lower. Along with inflation, which the CPI was at 2% since 2012. Mostly, outside of a few years when it rose slightly above 2%, but it always fell back below 2%. And this is dating up to pre-COVID levels. Even when we look at 2018, earnings started to peak, but then what happened? We lowered corporate taxes. The earnings started to surge. That was more in 2017 going into 2018. Then in late 2019, what do we see? Earnings kind of peaking. GDP was slowing from 3% in Q2 and Q3 to 1.9% in Q4. This is the quarter right before COVID. And that's okay. Because the Fed was there to make sure conditions were super easy. Not too hot, not too cold. But that's what Goldilocks is. The Fed's looking at this going, no worries. Even though we see slow growth here and there, and they'll pick out certain things, even though asset prices are continually hitting all-time highs almost every year since 2011-12. But just a little piece of economic data, GDP. It's a pretty big deal. Jobs weren't as strong. Just little things you could point to. And plus, listen, inflation was low, so let's keep interest rates low. There's no reason to go crazy. The Fed was there to help us out. No worries. Even on every pullback, it's a buying opportunity because the Fed's there to catch you. Goldilocks is no longer the case. And we're heading into next year, it's going to be different. And I'm always careful to say it's always going to be different, but it is going to be different because inflation is surging. The Fed's going to have to raise rates to control it. It's going to have to taper at a faster rate than previously announced. And you're going to have bulls out there. They're going to say, well, stocks usually go up during the early stages of tightening. That's bullshit. Because we have to stop comparing the past to the present and how it's going to dictate the future because we're in unprecedented times. I mean, 0% interest rates, trillions and trillions being thrown at every single problem. I mean, you throw out every investment book you ever read. If you read investment books over the past 5-6 years, you're losing money in the market. Buy low PE stocks, you're getting crushed. You're getting crushed. Because none of this makes sense, and nobody could look at which books are. Hey, this is my experience. This is what I learned, and here's how you're going to make money by everything I did and the mistakes I made. However, this is a market that never happened in history. I mean, it's true for those people to say, hey, you know what? Stocks usually go up during the early stages of tightening. I mean, that's a fact. Yeah, but the S&P did not go up 3 straight years before those periods to the tune of 31% in 2018, 18% in 2020, and 22% in 2021. We didn't have those conditions where we were up that much. So all of a sudden, you're going to take 1 year that compares. Hey, the last time we could have been down 3-4 years before that. And regardless of what the Fed did, whatever. And yes, the market was probably heating up a little bit, and that's why the Fed was raising rates or whatever. Again, they raised them briefly in 2018. You probably don't even remember the last time before that. I think it was 2008 or 2007-8, leading into credit crisis. They were raising rates while the market was crashing, which is insane. Just shows you the Fed's so behind the curve. But the comparisons are all bullshit now. But when the Fed raises rates, you need to understand it because what they're doing is they're taking leverage out of the market. And we're in the most leveraged market in history by a mile. By a mile, not even close. That's why you're seeing a lot of risky names get nailed. Or names that are seeing that strong top-line growth, but they don't have it in their discounted cash flow going out to 6, 7, 8 years, the analysts. These guys aren't going to generate money for a long time. Those names are getting nailed. I mean, one of the ideas, some of these names, I'm not going to just cherry pick like whatever. I actually screened for these names. Okay, these aren't bullshit companies. These are brand names with more than $10 billion market caps that have gotten crushed down more than 40% in the past 3 months. DocuSign down 60%. Their market cap is $26 billion. They shed over $30 billion in the market. Most of that we know was just a week ago when they reported the worst quarter you could probably ever see at a growth company. Peloton down 55%. That was a $30 billion company. It's $14 billion, right? So that was wiped out. DraftKings down 50% plus. Still has an $11 billion market cap. Remember, you're down 50% plus. You lost $11 billion plus in market cap just over the past 3 months. And Robinhood down 50%. Still has an $18 billion market cap. You go Bumble, LivePerson, SK Telecom, Lemonade, Compass, CRISPR, Beyond Meat, Virgin Galactic, Zillow, Snap. Snap's market cap is $75 billion. It's down 45%. Half of that wiped out. 30 days. Pinterest. $23 billion market cap. Zoom, $54 billion market cap. Those are the market caps today that are down 40% plus. 40% plus. Just over the past 3 months. No surprise, these names are getting destroyed. They're getting hit hard. The anticipation of leverage coming out of the market. They may think, well, you know what? We got China. China's the wild card, right? They're going to come to the rescue. It's a growth engine of the world, kind of 40% of the world's growth. Not anymore. China has its own problems. Forget about climate change. Just doing that for Beijing. And after that, they're ramping up coal like crazy, producing cheap energy, making a fortune, monopolies on rare earth minerals, killing us, right? Because we're idiots about climate change, deciding to change and have our oil companies, we can be energy independent. We are energy independent. Stop drilling oil. What are you going to replace it? We don't have anything to replace it with right now, but we're going to have alternatives in the future, right? You wonder why you're paying a shitload of money for natural gas, gasoline prices, heat your house, air conditioner, energy. You wonder why. That's why. Maybe you should have those alternatives in place before you have these oil companies and you force them to stop drilling because they're publicly traded, and you have the biggest companies in the world. You could do your research on it. They have trillions in capital, that the biggest positions are supporting this agenda right now. But getting back to China, who doesn't care about climate change? They do right now because Beijing Olympics are what, a month and a half away? Kind of 40% of the world's growth. But China, look what happened after Evergrande. That was a very, 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 very big story that kind of got swept under the carpet. Now, I'm not too sure if you saw the latest stats. I get them. That's my job. If you look at real estate, contract sales are down 38% year over year. Much, much sharper than the 32% decline that was expected. The government is trying to make borrowing easier. Not working. Those debt-laden developers are still in big, very, very big trouble. So they have higher borrowing costs, and they just shut those developers out of offshore debt markets over the past few weeks. What does that mean in layman's terms? Default risks are increasing for all these real estate firms, which most real estate firms carry lots of debt on the balance sheet. So what do we have now? We have inflation. The whole world knows it. Fed tightening. Constant uncertainty about future COVID variants. I mean, you can't be surprised. Most firms are lowering GDP estimates. This includes Goldman Sachs, who lowered their Q4 GDP from 4.2% to 3.8%, and also lowered their 2022 full-year GDP to under 3% now. Am I right? Talking about 3%? Under 3% now. Now you're wondering why so many of these names are getting hit. You're going to see leverage come out of the market, and you have to be careful with the Fed, because the Fed, what have they done year after year after year? If you're looking at the credit crisis, the worst thing that happened to the Fed is they made a fortune. They made a fortune. Everything they bailed out. If you're looking at the banks, you're looking at the warrants, you're looking at Fannie and Freddie, who is still under conservatorship, which is illegal, by the way. They're making billions every quarter. They took all the distressed assets that are worth probably 2x to 7x right now, and they made an absolute fortune. So what do? During COVID? Just spend even more money. We're probably going to make even more money. But this time it was different. They didn't do it to shore up the banks and make sure people know their money is there, which a lot of those banks didn't even lend some of that money out, or most of that money out. Instead, they handed checks directly to people. Trillions and trillions and trillions of dollars. $10.5 trillion in total for the U.S. $10.5 trillion. Put that in perspective, to save the world and the financial system, it was $480 billion. That's what they did in 2009, 2010. Now it's $10.5 trillion, and we're still going, right? Infrastructure, another $1.2 trillion. Let's keep going, keep going, keep going. So you have this massive leverage, but when you have troubling times, and even the Evergrande situation, or even the credit crisis or COVID, or things go under, you could always throw money at it to cure it. And that's fine, because we have an unlimited printing press that's on every second of every day. However, with inflation, it's the opposite. The Fed cannot do nothing. The only thing that they could do, I shouldn't say they can't do nothing. The only thing they could do is provide tightening conditions. Remove leverage from the market. It's a lot different. So you can't rely on the Fed and that Goldilocks economy. The Fed's going to be there. So it's not going to be always a buy the dip on every single stock. It's not. I'm not telling you 2022, every company's going to see massive correction, even though we saw most of them have a correction already. I don't know if you're looking at the underlying conditions of the market. And yes, if you're looking at the major indices, they're still 4%, 3% off their all-time highs, because Microsoft and Apple, if you look at Microsoft, Apple, Tesla, Facebook, Google, Netflix, Amazon, those stocks alone account for $12 trillion in market cap. $5 trillion alone just from Microsoft and Apple. $12 trillion of the $38 trillion in total market cap. And a lot of those stocks are at all-time highs, or pretty close to them. That's where the money's going. That's the safe haven. So that's keeping the major indices up. I mean, it counts for a third of it. But if you look at the underlying stocks, look at all those stocks that I mentioned. You look at ESG names, marijuana names, holy cow. And some of these things are down tremendously over the past 3 months. You're looking at it going, what happened? I don't understand. The market seems like it's doing good. It's really not. You're looking at the new lows to new highs. The new low list has been massive over the past 2 months. But yet you're seeing, hey, we're closing in all-time highs, because a lot of it is top-weighted from those big technology stocks. Now, if you're looking forward, I think, look, 2022, the cyclical recovery is going to continue. Airlines, hotels, casinos, rent-car companies should perform well as we're going to get used to living with COVID and all the bullshit. We are getting sick of it. We're not going to lock down and have overreactions other than New York and California, which, you know, you can't stop those guys. They're in that mode. Man, just insane. Insane. So funny. I feel bad for the people in New York. Anyway, you got a new mayor who I'm very optimistic about. So Eric Adams. Hopefully that will change a little bit. We'll see, hopefully. But you're looking at that risk of COVID, new variants. They're going to be around for a while. Just think you're not going to see these major overreactions. Plus, if you're looking at airlines, hotels, I mean, they're still trading 25% off their pre-COVID highs, especially airlines. Airlines are trading at the same level they were this time last year, other than bouncing this week. But how could that be possible when the vaccine, everything was shut down? The vaccines were just getting rolled out now last year. How could that be possible? Did you see the last quarters? I mean, they're like 22% off of their record revenue. That's not bad, considering they don't have international revenue coming in yet. But that's gonna change. Might not change next month. Might not change 3 months. But it's gonna change 6 months or a year. These guys have pricing power. Everyone's got to fly. You're gonna see earnings explode. These are great names to buy. Financials always do great in an inflationary environment. Be selective, because a lot of people say that, and these things have run up. Oil is super cheap, despite these stocks running incredibly high off their decade lows. When you're looking at Devon Energy go from like $6 to $40, like I missed it, but it was pretty much $40 3 years ago, pre-COVID. And here's a name that just got murdered. So now it's at those same levels. The fundamentals, financials are 10 times better. I also like biotech heading into the JP Morgan Healthcare Conference, which is next month right after the Consumer Electronics Show. Consumer Electronics Show, I'm going to be attending. I do lots of live events, so, be prepared. It's going to be really, really cool. But JP Morgan Healthcare Conference is right after that. That's second week in January. So right after CES ends, and that's been around 40 years. That's like, the Super Bowl of healthcare conferences. But you look at biotech, the sector got hammered this year, especially over the past 3 months. But this is a conference where companies report data and interim data within the phase 1, phase 2 studies, and I've seen names go up 50% plus. They didn't crash before that. Now we have a big crash in these biotechs. I think biotech is setting up. Look, is there risk? Yes. So you're going to try to catch a falling knife a little bit, but they're down so much that any good news, and a lot of these companies are going to be reporting at this conference. I mean, these things could pop anywhere from 30% to 50 to 75% in a couple of days. And think how wrecked oil companies are. We're there with a lot of biotech companies. I've seen companies get FDA approval. They're down 60, 70% from their highs. And they're about to start generating a shitload of revenue because they just got approved for maybe one of their first drugs. I've seen it. We just recommended a stock like that in Curzio Venture Opportunities. How could this thing be down 60, 70% when they're going to see an explosion in sales going forward? That's what you're seeing. It's just a rush. It's money coming out, algorithms. Doesn't make sense. But my advice is to be careful. And definitely start buying puts. Protect yourself. We do this in our Moneyflow Trader newsletter. Jenny does a great job of this. And if you're looking at stocks in just the past month, or past few months, right? So, Chegg is down 66%. Lightspeed's down 60%. Again, I went over DocuSign, Peloton, DraftKings, Grow Generation, and Bumble, LivePerson. So many names have gotten crushed. And if you bought puts on any of those names, you'd be up 3x to 10x on a lot of them, depending on what names, and what put you bought. But this isn't only how you protect yourself, given all the risks coming in 2022, where you see raising rates, tapering, inflation, growth peaking for many names, not to mention uncertainties of the next new variant that comes out. But what you're doing is, she's buying long-dated puts, and I'm going to be honest with you, this newsletter got its ass kicked because we've been in a bull market for the last 3 years, or the last 10 years. But what you're doing with something like this and with this product, or what you're doing with buying puts, is it's insurance. So you're taking your portfolio and saying, okay, here's my portfolio, 100% of it is long, which are most people out there. Take 3% by a long-dated put. You're going to be out of the money right away. That's okay. What you're hoping for is a 15 to 20% pullback over the next 6 to 9 months. If it happens early, it'd be better. You can take a little bit off the table. That's what you're looking for. And you can't tell me next year that's not going to happen. Are you crazy? With all the leverage being removed from this market and all these risks into the market? And you don't have the Fed there to just hold your hand and say, oh, it's okay, we're going to keep rates low. They can't anymore. They can't. Inflation's out of control. They can't. Powell just threw in the towel. You can't tell me that a lot of names aren't going to get nailed. There's still super high expectations for some of these names that are crazy. But take 3% of your portfolio. You know what? If it doesn't work out, you lose 3%. Chances are the rest of your portfolio is going to do well. A lot of those long positions do well. I mean, the S&P 500 is up, what, 20% plus? You did well. Big deal, 3%. However, if you're seeing a market collapse in your own puts, you're buying these puts, now you're going to see exceptional gains. I mean, that 3% of your portfolio, if the market crashes enough and really comes down, that could be worth more than your entire portfolio together. That's how you invest. And not only are you making money in a downturn, you have that money in your pocket, right? You're profiting from it. Now you could put more money into some of these stocks that are down 30, 40% from their highs. That's how you invest. It's a 10, 20-year plan. It's not like, hey, let me trade a day in a day. You want to do that. I know traders throughout my life. I met thousands of them. Thousands of them over the past 30 years. I know 2 or 3 of them that make money trading. Most of them get their ass kicked. It's just too hard. Just too hard. It's crazy. But next year is going to be rough. Valuation for some names, especially tech companies that aren't generating profits, are still insane. I mean, Virgin Galactic, right? That's SPC is a symbol. It's down from $60 a share to under $15 a share, but still has a $4 billion market cap while generating less than $1 million in revenue over the past 12 months. Not sure when the next ship's going to take off. It doesn't matter. I mean, who cares? Chamath and Branson already unloaded $300 million plus in stock for themselves. Murdered the retail investor. I mean, not a bad deal for Branson. You got paid $150 million to fly to space. But it's still crazy. And even when we look at cryptos, Doge still has a $23 billion market cap. It was $82 billion. $82 billion. Is that a necessity, Doge? Do we need that? What are some of the utility functions? I don't know. Shiba, $20 billion. That was over $40 billion 45 days ago. And a lot of bullshit, which we call shitcoins. And these cryptos with insane valuations. And if you own millions of dollars in Doge and Shiba right now, right? Say if you own millions of dollars you bought it, how are you cashing in right now? How are you cashing in right now? This isn't Bitcoin. This isn't, hold on for dear life. These are shit coins. How are you? These things could be worthless in 2 years from now. How aren't you selling the crap out of this and making a fortune? Are you nuts? There's a lot of leverage out there. It needs to come out of the market. It's going to be dangerous in 2022. Not a market to take on excessive amount of risk. Doesn't mean don't own small caps or don't own cryptos, but own the great names in those spaces. The ones in the middle of major growth trends, whether it's the metaverse, DAO, security tokens, DeFi, NFTs for crypto, or EVs, robotics, AI, ESG. Also, one major tech trend that most of you have not been introduced to yet, but you will in the weeks ahead. And if you're a Curzio Research Advisory member, you'll know tomorrow about that trend. This is one of the biggest trends in the world. Microsoft has put a ton of money into this, and it's a problem that's inevitable. And this technology has been around 2015, 16, 17. Now it's becoming cheaper. And you're going to see all the major companies. You got Harvard, MIT, all leading scientists and technology, all finding a way to make this technology work. And finally, you're seeing some strides. Just a little hint there. Again, Curzio Research Advisor members, tomorrow you're going to get that issue. You're going to know what I'm talking about. And I'm going to be talking about it later on. It's a massive, massive, massive trend that's finally here that nobody's really talking about. But when I mention it, you're going to understand why it's such a big deal and why those trillion-dollar companies, those companies with the trillion-dollar market caps, need to pour billions and tens of billions of dollars into this trend as fast as possible. And they're doing that right now, which is interesting. But stay with those trends. Stay with quality. Be selective with growth. I'm not sure space stocks, marijuana, online gambling. These sectors that are not going to see profits for a long time. They're likely to get hit next year as leverage comes out of the market. Yeah, with the Fed tapering and planning to raise rates. But you have to be selective. We're not in a market where you can just close your eyes and buy whatever and say, wow, look how much is up. Let me buy calls on whatever. It's not that type of market. Stocks with 10, 20, $30 billion valuations generating a few $1 billion in sales. Man, when leverage comes out, those are the names that are going to get hit, and it's already started. It's already started. I mean, you saw it. You're seeing it right now. You're seeing it with a lot of brand names that I just brought up. I could tell you another 50 names that have gotten hit. Those are the brand names, $10 billion plus market caps. But the Goldilocks days are over, and that's what happens when you remove leverage from the market, which the Fed is going to start to do next year, 2022. Okay, guys, I want to get to a couple of questions here. First one is from Mads. It's my buddy in Switzerland. Because, hey, Frank, hope you and your family have had a happy December and enjoyable Xmas. 2 questions. What is your take on DocuSign after the drop? Good entry point. Gold and gold stocks. When will we see some Christmas lights in the sector? We're overdue for a nice gold rally, but not sure what can light up the sector. It's all the best, Switzerland. I do think DocuSign's a buy here. It was a horrible, horrible quarter. And more to the point, you have to understand when growth stops, this is what happens to these companies. Look at Peloton. Look at Zoom. Look at all those names that I mentioned. When you have growth and it continues and continues and continues, that's fine. That's why Tesla deserves that massive premium. You're still seeing huge growth. They're the only ones with EVs on the market, even though everyone's talking like they're going to happen tomorrow. Ford, GM, we're putting these things out tomorrow. You're going to see it in Consumer Electronics Show. I'll show you pictures and stuff like that. When they're not really going to have any meaningful sales for that, probably for another 5 years. I mean, production isn't going to be that, to produce these things and sell them. I mean, it's not going to be as big as you think. They're talking it up like it's going to be. The reason why, Ford spent $30 billion on new technology, right, for EVs is because they don't have the current technology now. Nobody talks about that. They could have had it by buying Rivian instead of taking a stake in it, but hey, at least they took a stake in it because Rivian's now, at a $100 billion market cap. But they are a competitor and they have a nicer, much, much nicer truck, the Rivian, than the Lightning that's coming out, which is basically the Ford 150. So they're a competitor. And the Rivian's much, much nicer. Much, much nicer. Just do the research yourself and just look at it online. There's YouTube videos ever. It's awesome. So, DocuSign, right, got nailed. And I do. DocuSign's a great company. And I think it still has a lot more to go in terms of penetration. I mean, things that I do, I wish were in DocuSign still. And real estate is now, catching on where, mortgages and things like that. It's just a pain in the ass to sign 500 papers and read all, it makes sense. Private placements, it makes sense. There's still a lot of companies that I deal with and signing contracts and running this company and having so many different partners and stuff that they don't use DocuSign. It's a pain in the ass. So, yeah, I think it's a buy. I think it's a very, very good company. But, again, they put up a really crappy, shitty quarter and everybody ran. And the algos trigger and that thing got nailed. So I do think it's kind of a buy here if you have a 12 to 24-month horizon. And gold, look, I think now that stocks are getting hit, now gold comes into play. Because when everything's going up, nobody gives a shit about gold, no matter what the inflationary environment. But right now, remember, money needs to rotate. If it doesn't rotate or it stays in cash, these fund managers don't make money, and it's all about money. They need to make money, right? They need to that's what it's all about. So it has to rotate someplace. So you look at uranium, a lot of it started rotating uranium, finally. Now you look at a lot of sectors getting hit, inflation coming. Gold makes sense because the gold producers are the cheapest they've ever been. I don't know if I could say in history. But if you're looking at these companies, their earnings, their production, their costs are down significantly. They produce for under $1,000. What are we? $1,800 an ounce in gold. They're producing for $800-900. I mean, these guys, they're paying dividends now. I mean, they were so leveraged, they almost went out of business in 2012 and 13. They're the strongest they've ever been in history right now, and they're great, great buys. They're generating huge earnings, again, paying dividends, massive cash flow. They get to pick it a little with all these shitty junior miners to say, okay, we'll pay you for this because all the junior miners are still not doing well. And they've never been in a better position. So, yeah, I think 2022 is going to be the year. Although, I could have said that last year and the year before with inflation coming up. But, hey, it hasn't happened. But gold, now that the market is coming down and you're seeing certain sectors get hit, now it makes sense for some of that money to rotate into gold when you could have rotated to anywhere and made a lot more money in any other sector because it's a bull market. Next question is from Dan. This is the last one. He goes, I love your new format with YouTube videos. Guys, catch us on YouTube. It's really cool. We're going to be producing a lot more stuff, even live videos on YouTube and stuff. So, yeah. And you get to watch my beautiful face, which is cool. But I like YouTube, and it's a great platform. He says, I watch you, Daniel, Luke, all your videos, and I'm a subscriber to 3 of your newsletters, Dollar Stock Club, CRA, which is Curzio Research Advisor, and the Big Money Report. They're all insightful and calming for days like today. I recently watched a video from Powell, not RuPaul, but Powell, discussing the Bitcoin to gold ratio. So Powell has videos and people, he's got a really good service. He goes, I own several of your gold recommendations. His crypto bugs seem to poke fun at gold bugs. I'm both. I own Bitcoin and gold. I'm bullish on both, adding to both when I can. What are your thoughts on gold, Bitcoin, and crypto these days? Is crypto losing momentum, at least versus gold, and maybe versus other assets? Are both still worth adding? I'm glad that you own both, which is really cool because it's a lot of times it's either or, and I can never figure that out, why it's either or. But when I look at which one is better, I don't know. But I know that the Bitcoin to gold ratio is garbage. Throw it out. Print it out, and then crumple up and throw it in the garbage. It's like the gold to silver ratio. You're talking about two unrelated things. Okay, I mean, you could pick two asset classes and make a ratio out of it. But, and for instance, it's not like money from Bitcoin is going to ever flow into gold. It's not. The younger generation is in Bitcoin. They'll never, ever buy gold. We're in a digital economy. That's what they grow up in. Buying gold is like you buying a VCR to them. Okay, you're going to buy a VCR? No, you're not going to buy a VCR. I don't know if you can buy a VCR anymore. You probably can someplace, maybe used. So, comparing those ratios, like money's going to flow into one and then flow into the other and go back and back. I mean, has that ratio even worked since 2009, since Bitcoin was created? 2008? I mean, you're looking, especially over the past 4 or 5 years, where you saw Bitcoin go up how much? I mean, so to have a ratio there just doesn't make sense of like determining whether I should put more money into gold or more into Bitcoin. Both of them work. Love Bitcoin long-term, love crypto long-term. I like this correction. It's something that I was telling you about. I said, look, we want this market to come down. We're taking small positions, and then we could build them up over time. That's how we got 30x, 40x winners in our portfolio. A lot of those things were down 20, 30%. It's volatile. There's a lot of leverage in the market, but the most innovation is coming from crypto. It's disrupting everything. It's going to disrupt every single industry. The metaverse has to flow through crypto. It's going to flow through crypto. Take a look at the Decentraland. They have the technology already. Facebook could actually learn a few things from these guys. Roblox as well. But you're looking at DeFi and DAO and security tokens starting to take off. I mean, this is disrupting Wall Street, which they're middlemen that make a fortune. That's never been disrupted before. Never in a digital economy. I mean, these guys still make a fortune bringing out these issues. They make whatever, 3 to 6%. They get shares. They put them in their funds. And then Goldman's going to go ahead and recommend them through their research division and put a crazy price target on it with a buy rating only because they were able to get shares of this stock and the whole roadshow. I mean, there's probably like 6 conflict of interest just in that statement I just said. But it's okay. That's what they do. They're middlemen. They're making fees. They say, hey, you have a pretty cool company. I got a good idea. Good. I got a bunch of people that will buy that idea, and I'm going to take a percentage of that. It's a middleman, right? Middlemen seem to get cut all over the place, except in finance. Now you're looking at payment systems. Imagine not being charged processing. That's what happens with Bitcoin. I mean, this is massively disruptive to where, trillions, if not tens of trillions of dollars in credit card processing fees, credit card transactions. I mean, this is disruptive all around. So I love crypto. Gold as an inflation hedge, I really, really like right now. I'd stick with the producers, and a couple of those smaller names should do well, but I think gold's ready to surge. I thought that really last year. But when you see a market where every single asset class is going higher, people just are like, I don't really need to be in gold. Yeah, we're seeing inflation. All right, maybe I'll go into Bitcoin or I'll go into banks because banks are taking off and I can make so much more money. Now you're looking at gold. I would buy the producers rather than gold itself, or you have to be selective with junior miners because I've been in that industry. I have great sources that allow me to have unbelievable contacts. 85 to 90% of that is garbage, and they're trying to scam you in the industry. I've never seen the industry that many scams. Be very, very careful. Make sure you listen to the right people like Jeff Phillips, Marin Katusa. I mean, really great guys in the industry who have helped me really, get to the top of the industry and just, learn. And I've had some very bad experiences getting wrecked. So just be careful with the juniors. Everybody has a great story. Next thing you know, that the biggest tell is when you buy that stock because of what the CEO said or whoever was pitching it, who's within the company, when you see them 3-4 months later call you and say, hey, I got another idea, sell that stock. I don't want you to have another idea. I want this to be a freaking idea that you pitched to me. That's the idea. I'm in it because of you. Now you're talking about another stock? Are you kidding me? The biggest tell right there. Get out of the stock. A lot of bullshit in the industry. Be very, very careful, but I'd stick to the major. I think both of these asset classes do very, very well. I think Bitcoin is a buy on this pullback. Again, we said, don't take a full position at 60 grand, 50 grand. Even if you go in it now, take a small position. It's going to be extremely volatile. But what I do know, what I feel I know, 3 years, Bitcoin's going to be a lot higher. I mean, at 3-year outlook, if you're looking at that way, it's going to be a lot higher. I don't care about a 20% correction here, a 10% correction here. It's all over the place and money coming out. Everything's going to Bitcoin. You see more and more banks. Regulation, it has eased tremendously. And you're seeing the biggest banks get in it. You've seen the biggest institutions get in it. They have to get in it. They have no choice because this is a $2 trillion plus market now that you could see amazing returns in, and their clients are asking for it. So when they're asking for it and they could generate fees off of it, that's when the institutions come in. Again, it's about the money. They couldn't do that in 2016, 17, 18. It wasn't enough volatility. Now this is a massive, massive market that they're all late to the party getting in, and that's going to make weeks like this where Bitcoin comes down 20%, huge, huge buying opportunities, as long as you have a 2-3 year horizon and longer. That's the way I would play it. Okay, guys, that's it for me. Questions, comments, feel free to email frankcurzioresearch.com. Really appreciate all the support. I'll see you guys tomorrow. Take care.